we also have interest rates going up. And so you're taking out a loan on the car, and the loan itself, the interest you're going to pay is just more on the car. So
Yeah.
those two factors. But then the third one that you didn't really talk about, but I think has also been a part of this, and this is the like me putting my Elizabeth Warren hat on for a minute and like,
Okay.
shaming these greedy capitalists. But there is definitely a dynamic that's been happening even before the pandemic where dealers were making more money on the loans than they were making on the cars. And
Oh,
this is a trend that's been
yeah.
happening for a while, right? And so, you go in and you buy a car and there's actually stories about this that have been reported in the New York Times and elsewhere, but there are people who said, yeah, I went to go buy a car. I told them that I wasn't going to use financing, and they actually refused to sell me the car, right? Because dealerships were like, no, I can't make any money if I sell you the car. You have to get financing with it. And so there's been this
Yeah.
very weird dynamic where dealers have sort of reoriented themselves around selling the loan, the
True.
insurance, the add-ons, all the other things. And the car is just a vehicle for doing that, much in the same way that Delta and United
It's just
are
more.
flying planes around, but it's really just a mechanism to get you to participate in their credit card scheme. Cars have become kind of similar, and
Yeah.
my theory about that is that also has created an incentive through the whole ecosystem for car prices to be higher, right? Because if the dealers want people to take out loans for cars, they're going to have a demand on the part of manufacturers for cars or models of cars that are more expensive.
Yeah.
And manufacturers are going to have an incentive to go, well, if dealers can sell these, let's just go ahead and increase the price. And so I do think there has been some inflation in car prices that has had more to do with the incentives of the distribution of
Yeah.
cars, disconnected from supply chain and inflation going up and other things. Those obviously have also had an impact. So there's been this sort of like perfect storm of things, and the result has been auto lending has been way overheated
Yeah.
for like 5+ years. I mean, it's like been like way overheated, and you've definitely seen some of the savvier auto lenders starting to kind of tighten credit and kind of like tighten up their boxes. And I've seen that in the subprime space with
Mhm.
the One Main Financials of the world. You see it more of the sort of near prime and prime space with Ally and Capital One and some of the big sort of indirect auto lenders. You even see it a little bit with the captive auto finance
Yeah.
companies that are owned by the manufacturers and are trying to move as many of these vehicles as possible. Like the whole space is kind of overheated. And so I'm with you. Like if you were to sort of guess what's the category of consumer lending that does cause a larger crack in the overall sort of lending performance, I think auto lending has to be the favorite by far.
Yeah. The other thing too, and okay, so I bought a new car, and it was kind of an accident. I had a 2016 car and I took it in to get an oil change, and that, the dynamics of that day or that month was that, I had positive equity in my car, weirdly.
Oh yeah.
So because used car prices were so hot, they
were like, please sell us your car.
they were like, please sell us your car. We'll sell you a brand new car. I basically kept the same car payment.
Wow.
The car is more expensive because it has more sensors and stuff. But the one nice thing is that when you kind of buy a new car, you can only pay so much above sticker price, right?
Yeah.
The cars are more comparable, right?
Yeah.
And the financing is a little more, I think for me, the financing kind of works out a little bit better because they can't really mess around with what the car is worth. And,
Right.
if you've seen used car prices to new car loan prices, I feel like the new cars have lower interest rates, whatever. So that day I had weird positive equity in my car and sold in my car. And so I kind of, and it had 100,000 miles on it. I sold a 100,000 mile car with positive equity, and it was my down payment. And then to think that it's weird that I did that. It's weird that, I walked in for an oil change and used car prices were so high. Demand for my 2016 car was going to be so high that I could just weirdly trade it in and keep the same price, the same claim. The other thing too, and we saw this post great recession, was that in order to make cars more affordable, they have stretched out the loan rate.
Right.
So
Longer terms.
6-year and 7-year car loans used to be really rare. And I actually think that's pretty common now.
They are.
In a way that kind of hides some of the affordability dynamics. If you can just stretch out that loan term to be like half of a 15-year mortgage, or like the average price of a student, like a student loan that someone is going to pay back, right? Like that you could have your 7-year student loan.
But there's there's a tail risk associated with those ones, right? Because like we used to give out auto loans on like 5 years or less. And our expectation was that like you weren't going to be stacking up too much debt. So I guess the concern would be you lengthen the term, you reduce the ability to pay crunch in the short term, but you're adding another level to the stack of debt that consumers can take on, right?
Right. So it'll just be really interesting to see going forward, like how bad car delinquencies get. And again, this is like, you can't be surprised. Like the surprise is that this hasn't happened yet, right? Not that it's happening now. It is, when you have these affordability, when you have these constraints, when you have the like weird incentives, right? You will end up with delinquencies.
Oh yeah.
And honestly normalized delinquencies. It was unusual that credit losses were so low. So the question is just what's now normal?
Yeah, no, I think that's exactly right.